Sonali, your S&P outlook for 2026 is more cautious than a lot of other Wall Street prognostications. What is it and why is that?
We're looking at fair value for the S&P 500 reaching as high as 7,400 this year. We are in a midterm year. In midterm years, on average, you tend to see underperformance of the S&P 500 relative to when you're not in a midterm year. So that's less than 6%, around 5.6% on average versus closer to 12% otherwise. Now, we don't think it's just because we're in a midterm year. We think that there are a lot of blind spots that the economy still needs to work through. But generally speaking, we're constructive, but perhaps not as through the ballpark as you're seeing some of the other strategists this year coming out and saying.
Well, one of the primary bull cases is that we're going to get a new Fed chair in 2026 who's going to cut rates significantly, and which will in turn help stocks. What is your outlook for the Fed and for rates in 2026?
We think that the Fed is largely on hold for the first half of this year. And why is that? When you look at the macro, it's been holding up. We're in a low hire, low fire economy. We think the Fed will try to get back to neutral. But when you look at inflation, also a big blind spot. We're sitting here today and we think you can get back to the Fed's target, but maybe a little slower than some people expected. Not to mention that when you work your way through the year, tariffs, for example, one big uncertainty, will we still see bouts of inflation that will make that path a little rocky back down to 2%?
I'm going to stick with the bullish case. A lot of people say, but we have momentum. From the past 3 years, these capital markets keep not just going higher, but they're broadening out. What's your reply?
The early part of this year has been really exciting on the broadening trade because you are seeing the big tech narrative changing. We've been saying for months now that people are going to get more selective. And so the room for broadening out is getting interesting. Financials, earnings growth has been very healthy. There is still uncertainty on the regulatory front. You think those credit card interest rate caps, for example, whether we see them and how that might impact margins moving forward. But generally speaking, you think about AI, for example, the potential for AI to broaden out into different parts of corporate America and create some margin improvement. We're already baking in, for example, for 2027, 355 EPS. That is earnings growth from here. A lot of strategists are expecting about 310. Put a 21 times multiple on it. You get to that 7,400 quite easily. We're open to reassessing that this year. But when you look at those uncertainties, you can't look past at how much we don't know about the macro right now. And that same is true for the Fed. We've got to see the data come through before you can see that interest rates cutting cycle take off, especially if you see some more inflation down the road. Then, can you really see as many rate cuts as many people expect?
And the momentum hasn't just been into the Magnificent Seven and large cap tech stocks. There's been a lot of money going into private market assets as well. What are your thoughts on this? Is that going to be a good play in 2026? Because certainly there's a lot of money headed over there.
Fun enough to ask this question at this moment because RIAs that 6 months ago would say they're not interested at private markets at this moment have quickly turned and changed their mind. And it's because clients are asking for diversification, and reasonably so. You look at the stock market, we're near record highs. You look at the uncertainty and it's palatable. There's volatility in broader markets. You look at the bond market and it's not considered as safe as it used to be. There's tremendous volatility. So then private markets, where there's some opportunities, infrastructure. If you're worried about inflation, people are really excited about infrastructure, both digital and regular way. There are huge financing gaps. That's a projected $15 trillion gap through 2040, for one example. People are looking at venture capital again, given the AI story and the valuations that are perhaps more attracted in certain parts of venture capital, if you can note the dispersion, right? You want to get into those top quartile managers. And I would also say private equity, there are complexities as people start to try to seek that exit route for existing investments, but for future investments, small and medium-sized buyouts, valuations still look pretty good.
So finally, I'm going to play devil's advocate one more time. A lot of money has gone into private market assets over the past few years. Is this a risk that this trade is just getting too crowded?
Private markets are a really big landscape. I always ask myself the question, if you're looking at public markets and you're picking your fund managers, you would look at their track record, wouldn't you? You would also look at them and say, wait, there's a big field out there in terms of how people play through these markets. And private markets, again, you've heard me say infrastructure, private equity, venture, to choose different spots. Certainly, I think in the early part of 2026, there's going to be a lot of headlines around private credit. There certainly have been. There are still some attractive returns, but in all of those parts of private markets, I would say there have been a lot of tourists in the last decade entering these markets when interest rates were low and you looked at the macro being really benign. Times are getting choppy and people are going to be able to differentiate themselves as very good managers or managers that were just riding a wave.
All right, well, thanks for coming and talking about it.
Thank you. Appreciate it.